Ladies and gentlemen, welcome back to another day of the stock market crashing in 2022. After all, what is new? Now, we need to talk about exactly what is causing this 2.5% drop in the S&P, over 3% drop in the Nasdaq, guys. And a lot of this is because of Fed Jerome Powell yesterday. And we're going to break down in English why this is happening. So first and foremost, we got the summary of economic projections. This is where the Fed thinks interest rates will go, where inflation will go, where unemployment will go, and where GDP will go over the next 2 years. And only two members really were in line with market expectations that expected the federal funds rate to be 4.9% by the end of 2023. And believe it or not, the markets were actually pricing in about a 4.5% federal funds rate by the end of 2023. So I shouldn't even say two were in line with market expectations. The two members that voted for 4.9% were still higher than market expectations, and this is by the end of 2023. The average FOMC member thinks interest rates will be 5.1% by the end of 2023. Markets were expecting 4.5%. They were expecting 2 rate cuts in 2023. Fed Jerome Powell said absolutely not will we be cutting rates or thinking about cutting rates in 2023. 7 members think the federal funds rate will be 5.25% by the end of 2023, and 2 members think the federal funds rate will be 5.46% by the end of 2023. So in English, what does that mean? That means rates are going to be higher for longer, basically upsetting what the markets thought was going to happen. The markets have it wrong, or the Fed has it wrong, and the bond market is starting to call the Fed's bluff. We'll talk about that here in this video, but that is why markets are freaking out here today. And you also got GDP coming in at 0.5% for 2023. That is the Fed's expectations, or the average view from all of the 17 FOMC members. So in English, that means higher rates for longer and borderline a recession. The Fed also thinks the unemployment rate will tick up to about 4.6%, about 1% higher than where it currently is, which historically would be in line with a recession as well. So we see where things are going. They're getting more and more hawkish on the state of the economy, and when you get more hawkish on the state of the economy, when you start to talk recessions, you have to talk about lowering valuations for the stock market, and that is what is currently happening. Now, it all depends on obviously earnings, and we'll see once earnings really start to kick off how companies are doing. That will be the most important thing of 2023, will be company earnings, but we are not quite there yet. But what we are getting today is retail sales that fell 0.6% in November as consumers feel the pressure from inflation. This number was 100% worse than what we thought it was going to be. Retail sales, we were expecting for the month of November a 0.3% drop. We declined 0.6%. So throughout 2022, bad economic data has been good for the stock market. Now the focus is on a recession and where earnings will go. So I think bad economic data will start to be bad for the markets, whereas good economic data will start to be good for the markets. You also seen a weekly jobless claims number that fell to 211,000, a decline of 20,000, and well below the Dow Jones estimate for 232,000. So that is bullish. Fed surveys from the New York and Philadelphia regions showed contraction in manufacturing activity in December. Also not a good thing. So what you're seeing happening here is fears of a recession and the earnings outlook getting worse and worse. Literally by the week, it seems these things are getting worse. Now, remember how I said the bond market was basically calling the Fed's bluff? And that is because bonds are up 0.84% today. Now, why is this important, you might say? Well, when bonds actually rise, that means people are buying bonds. That means the yield is falling. Kind of like if you buy a dividend stock that is $100 that pays you out $5 per year, that's a 5% yielding dividend stock. Well, if the dividend stays the same, But let's say that stock price, because people are buying it, right? They want that dividend. They want to own that equity. If that stock goes to $200 and it's paying you $5 a year, well, now that dividend is 2.5%, even though the company did not change a single thing. That's how the bonds work. So when the bonds are going up, the yields are actually falling. Why would the yields be falling if the Fed is saying, no, we're going to hold these rates at 5% throughout all of 2023? It's because the markets, the bond markets, think the Fed is bluffing. They don't think the Fed will be able to keep federal funds rates over 5% throughout 2023. So the bond market and the Fed are in a massive tug of war right now. Usually the bond market is correct, but if the Fed is correct this time around, well, it could definitely shake up the bonds. And what we've seen throughout 2022 is bonds have been falling along with stocks. That's why this whole argument of the 60-40 portfolio, 60% stocks, 40% bonds, a lot of people have been saying in 2022 that is dead. That no longer works, which was true. Stocks declined, bonds declined. One of them should have accelerated when the other one fell, right? Long story short. But what is happening now is the bonds are rising. The bonds are rallying. People are buying bonds, but they're selling stocks. And you've seen a divergence here, a quite strong one, right? Bonds have been rallying ever since November, and stocks have basically been falling ever since the last couple of weeks. And this divergence, the stronger it gets, the more likely you are to see a major stock market event, a major flush out event, guys. So there you have all of that information. As far as the S&P 500 is actually concerned, you just broke under the 100-day moving average here today. You were not able to hold that level. Next stop is going to be the 50-day moving average at 385.49, and we might actually clear that by the end of the day today, and that would be very interesting. Now, tomorrow is going to be Friday. We have all the economic data out of the way that we are going to get. There's not going to be too much for next week. You are going to start getting some company earnings, though, and that will be the biggest thing in 2023. Forget any of this. Forget where bond yields go. Forget what the Fed does. Forget all of that. If company earnings can hold up, then you will be able to rally in 2023. That's just the bottom line fact. If earnings fall, you will fall in the broad markets. That is how this is going to work. And unfortunately, what the markets really care about, they don't care about all earnings. All earnings are not built the same in the market's perspective. They care about Apple number 1, Microsoft number 2, Google number 3, Tesla number 4, Amazon number 5, almost in that exact order. Definitely Apple and Microsoft, Amazon, Google. Those are going to be the top ones. Tesla, Nvidia, these guys are lower tier, but they're still important. If those companies have bad earnings in 2023, you are in for a complete shit show. And that's what the markets are starting to try to price in right now. Where are earnings going to go? How much does the stock market need to be discounted as of right now? And we've got JP Morgan, Bank of America, Citi, Wells Fargo, Goldman Sachs, Morgan Stanley, all of them essentially calling for a really rough first half of 2023, a 20% or more decline from these levels, and a lot of them think we're going down to 300 on the S&P 500. Finally, we'll bottom out around there, and then the second half of 2023 should be a lot better, right? That's the average consensus. If you need to go down to 300 on the S&P, that would be a decline, let's pull it up, of about 23% from here. Now, I'm not going to say that is right or wrong, but what I will say is if earnings even come down 5 to 10%, that's probably where we are headed with a 5% federal funds rate. But at that moment, that's probably where the Fed would pivot and start being a little bit more accommodative. So there's a good and bad there. You want to be able to survive the last flush out, make sure you're not in so much margin that you're unable to do anything, right? You want to be able to take advantage of the lows that are coming, essentially, But it could be a little bit of time, right? We don't have earnings just yet. We're going to have to wait a couple more weeks for those big dogs to report earnings and send the markets either higher or lower. It does not look promising, at least to the upside as of right now, guys. So there is all of that information. Like I said, key technical levels, 100-day moving average, 50-day moving average. On top of that, I like to pay attention to the Ortex data. If we go ahead and pull up the S&P 500, we could see the option activity for the day is sitting at, let's let it update, is sitting at 53% positive order value, about 3,000 orders so far on the S&P, worth about $367 million. So 53% positive order value is a lot lower than what we are typically used to seeing on the S&P 500. As far as the short interest, that is estimated at 14.29%, free float out on loan at about 4%, shares out on loan about 38 million. So there's still about 38 million shares that could be sold short against us at any moment in time. So keep that in mind, guys. Not really looking too short squeezy. We're not too high on the short interest, which again is not a good thing considering the stock market is falling. That means there's a lot of room for the short interest to actually increase over the next days and over the next weeks. The dollar is rallying again today. Like I said, fundamentally not a positive thing. And if we go ahead and take a look at the VIX is at 2280. So you're not even in any kind of fear level. You're still down here in really the bounce levels of 2022, where we have been on this lower end range. That's not that's not a positive thing. If you go up higher, if you really see the VIX start to rally, well, that's going to mean a lot more pain for the stock market, guys. So that is going to be it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.